Hi. All right, since Peng is finally here, so hi everyone, welcome to the E27 webinar. It's so good to see you all again in this wonderful Thursday. So before we begin, I'd like to explain a bit about what we're doing here in this event. So we started the E27 webinar series to facilitate learning and development of the startup community in Southeast Asia. Every 2 weeks, we bring in expert speakers from the region to share their experiences and best practices on contemporary challenges. Now, kindly note that this session is recorded and we will be sharing the video post on our site later. Now, today, our special guest for the day is the managing partner of Monk's Hill Ventures, Mr. Peng T. Hi, Peng.
Hi.
Hi, how are you?
Good, good.
All right, so a little bit about Peng here. He is a veteran entrepreneur with over 25 years of industry experience as both an entrepreneur and investor in Silicon Valley and Asia. So today, what we're going to talk about here with Peng is about basically the world post-pandemic. It has been a very challenging time for the startup ecosystem, and here we're going to learn and get insight from him on how we are going to best deal with this situation. So now, let's not waste any more time. So we're going to start soon. I'm going to stop sharing my screen so that Peng can start to share his. All right. Feel free to start, Peng. Yes.
Yeah, feel free to just start with the questions and then I will check the right slides for it.
Yeah, Peggy is driving the slides.
All right.
Everyone, please meet Peggy.
Yeah, hi, Peggy. Thank you for helping out. Okay, Peng, so maybe we can start with the notable changes that you have seen in the Southeast Asian startup ecosystem in the past 6 months, especially with what is going on in the world today.
Yeah, I think this is the first downturn recession in my lifetime, right? In a very long time, where the economy actually shifts. It's not previous recessions, you just have general lowering of spending levels across. In this one, certain industries just disappear, right? There's no travel. If you're in, F&B, lots of problems there. And then in others, it actually goes up, right? If you're in content, if you're in collaborative systems, Zoom's MAU is going through the roof. If you are in logistics, e-commerce, you're doing fine, etc. So, the new normal is sort of very different from the old normal in terms of how the different pieces of the economy comes together, right? This is the first time it's ever happened where the airline businesses are basically bankrupt, right? If you own an airline, you're basically bankrupt, right? So what does that mean for us is that, the slide we put up there is lots of things that are doing well and a lot of things that are not doing so well, right? So, but I think it's important to note that if you go to the next slide, that if you start asking questions about how do we get back to normal, right, as it used to be, you start asking all these questions, you start to realize that there's not a lot of clarity, So my point to people, I don't say new normal, I say new normal ? Is because you think it's normal now. Wait 3 months, wait 6 months, it's going to change. Wait a year, is going to change, right? So we are in a very difficult environment because of just the sheer lack of predictability on what's going to happen to the business. And that's how we think about the world. And so our practice of using first principles to look at business and business opportunities is even more relevant today because, you cannot look at how things are today and go, yeah, it'll be the same but bigger in the future, right? It could be very, very different. Healthcare spending, even if you're in the content business, right? You sell stories, you sell games, you sell content. That might pick up now, but maybe when the world starts readjusting back to normal, it might drop back down, right? Games for sure is going to be one of these areas, right? So how do you take advantage of, for those businesses, how do you take advantage of your current increase in revenues to lock down more users for the future? So questions like those are strategic for the companies that are doing okay in this time frame.
Okay, I see. So if we're talking specifically about startup investment, are there any notable changes that you notice now? Like, for example, in the way investors are approaching investment in the region after what happened here?
Yeah, I think there's almost a little bit of a Cambrian explosion of different strategies, right? Because this is a world that none of us are used to. So some people get very aggressive, some people pull back and don't invest, you know. So there's different takes. So there is not one VC view of the world today and how we react to it. We would have done about 3 deals this year so far.
Okay.
So we're not obviously stopping investing. We're continuing to invest. Can you go to the next slide, Peng? But we look very carefully on how to invest. And this is one of the ways we look at the world today, what's on the screen. We call it the buckets view of life. So this is the reason for this bucket is COVID, right? COVID has caused a bunch of companies to be doing really well, right? And those are the bucket A, and a bunch of companies to be really, really hit hard, right? That's bucket C. And then there's a whole bunch of companies in the middle that serve both A and B, both A and C, and some are B minus. You know, if most of your customers are in bucket C, then you're probably B minus or C. And then those are, there are some that are like logistics serving e-commerce. Those are doing really well, right? So that's how we look at the deals today. I think most VCs will have some perspective on this, and they would have a perspective of focusing on the buckets A, right, in the short term. It's unlikely to see a investment, for example, in a travel company in the next 6 to 12 months, right? It's just, we don't know what's going to happen to the travel industry in the next 2 years, right? So, that said, at some point there'll be recovery, and if you survive to then, you do probably okay. There'll be a lot of pent up desire to travel, but right now it's really hard to see that. Whereas today, you know, if you're a logistics company, you can actually see an increase in especially if you're last mile, you can see an increase in the revenue numbers, specifically because of e-commerce, right? Everyone's ordering online, so you need that delivered. So we look at companies. When we get a company, we try and very quickly put them in A, B, or C, and then look at it accordingly. And we focus on the bucket A for investments.
Okay, I see. So basically, in terms of categories, you are putting all these companies into these 3 different buckets. And how about stages? Do you focus more on growth stage investment at the moment, or do you continue with early stage investment?
We are a Series A company, so we focus mainly on Series A, the first post-seed round, and we're continuing to do that. Seed is not our expertise. We're open to doing some seed deals, but it's not our expertise, and we don't focus on it. And Series B and C are much further along in revenue pipeline and all that. So we think it's to our advantage to come in Series A once you have some kind of sales engine going, and we look at. But by the way, the buckets view of life is one of the ways we look at the companies. But we also, as I mentioned earlier, look at the very first principles. How is this business going to work today, and how is it going to work 12, 18 months from now? And we don't do a lot of deals. So if you're a seed investor, you have to do a lot of deals, and there's a risk on that, specifically around now, because of the uncertainty of the economy. And the last point is actually very, very important. We've had a number of entrepreneurs come to us and say, we need to raise, X million dollars so that we can survive through this next 12 to 18 months. And generally, we don't invest to help you survive. We invest to help you grow, right? So if the business, like if you're in travel right now, it's really hard to grow travel, right? You can imagine. So, so we typically don't invest in those deals. Hopefully that clarifies. I think it's, to answer your question more specifically, I think it's a bit harder to do seed deals right now because of just the environment keeps changing and it's uncertain. And one of the jobs of a seed level company is to figure out predictability of revenues, right?
All right, I see. So my next question would be now about the next stages, like for example, exits with IPOs and or M&A. So do you see that with what is going on at the moment with investors being more careful in doing investment, do you see that it will also affect exits in the end?
Yeah, I think if you survive through this COVID timeframe and you build a pretty robust company, and the good news is the companies that survive this will be very strong companies. It's like Google surviving the dot-com bust, Facebook surviving GFC, they end up being very strong companies. And at that point, the options are all open. You can sell the company, you can take it public, there's lots of things. So my view on businesses is very simple. Build a strong business and your options just open up.
Okay, I see. So yeah, when we're talking about running the business itself, so ever since last year, the startup community in Southeast Asia, we started to have like a stronger awareness on the importance of being a sustainable business. So we see that many companies are changing their approach in user acquisition. Like for example, they become more careful in the way they're using their runway. So I imagine the same will also happen with what's going on with the global crisis at the moment.
Yeah, I think the COVID crisis just reinforced the post-WeWork kind of attitude, right? Before the Uber WeWork, all the sequence of events last Q3, Q4, there was this idea that you can just burn money and grow the business and people pay higher valuation, right? And we built a lot of big companies that way, almost too big to fail, some of them. But I would say as companies go, there's almost no too big to fail tech companies, right? So that kind of view of life was basically enabled by a few large funds at the top, right? And the idea was those large funds would fund the companies and take them public. And then what happened was when they tried to take them public, the public market said, no, it doesn't work for us, right? So then they rechanged. So everything started pushing downwards. So now the investors from A, B, and C, they start to go, okay, maybe we shouldn't go down that path of what we call negative blitz scaling, right? Really growing a company fast with bad unit economics. Now that started happening actually before COVID, about 3, 4, 5 months before COVID, right? And people were still thinking, oh yeah, it could change, and maybe other people with big piles of money could come back in and bring up the environment again. Well, turns out that COVID just tells you, look, you got to build a real business. You can't fool around. You got to look at the money you have. Can you build a profitable business before you run out of money? Very basic questions now. So in some ways, we got to thank COVID for getting our entrepreneurs and our startups back to basics, right? Can you very clearly build a profitable business out of this? Can you build what's your path to making sure you can break even with this business, right? And a lot of us are realizing, oops, we don't have that. Right? And we're going to see a number of companies go away simply because they don't have that, and you cannot raise any more money. Right? There's two ways to fund a company: from your customers or from investors. The investors are pulling back, right? So you got to fund your company through your customers, right? And that means creating real value, creating profits, or at least breaking even, right? So I think that's here to stay for a while.
Okay, I see. So for multiple ventures at the moment, is there any changes in the way you are looking for these new companies? Because I imagine all the meetings are moving online right at the moment, right? So is there any differences in the way you are running this pitching sessions?
Yeah. One of the questions, the companies we invested in this year, we actually met them pre-COVID. So we actually got to know the entrepreneurs and all that. So we haven't had a case where we think we want to invest, but we've never met the entrepreneur. The good news now is the world's opened up, so we can actually go meet them with masks. So it's a less difficult situation now, right? I think we'll move a little bit back to the normal world at this point, the pre-COVID world, but with social distancing and all those good practices. Hey, by the way, I see a lot of questions coming up from the chat session. I'm assuming you're going to look at them.
Yeah, we're going to go to the Q&A.
So I won't pay attention to that unless you.
Yeah, don't worry, we'll have time for them.
I got someone saying hi, Peng. I'm not sure I should say hi back.
Yeah, so we've done a lot of webinars before this with VC firms, right? And one of the most commonly asked questions by startup founders is that, what is the best option for me at this moment? Like, should I hibernate? Should I do some changes, like maybe even making a pivot, especially if I were in the affected industry? So what are the advice that you would usually give to your portfolio companies?
Yeah, it's about runway, right? What you have if you're in the bucket C companies, right? Life is going to be hard. You're probably not going to be able to raise money, although we actually do have a travel company that just raised a whole bunch of money, right? But those are strategic and it's long term. They think when the travel industry recovers, they'll be like one of the top players. So those are rare. That's an exception. If you're in the travel business, the restaurant business, a lot of these, it's going to be tough, right? And especially if you're like series A, B, C, it's going to be tough. The ones that raise tend to be much bigger, right? They're ongoing concerns. So what do you do when you are faced with a situation where you got a fixed pile of cash, you cannot increase your cash anymore, and you got a business that's not really generating any revenues, right? So this is the first time in my career as an entrepreneur and a VC that I've actually suggested to some entrepreneurs, maybe you should consider hibernation, right? Because right now, if you're in a business that's not functioning right now, right, and you stay open, usually in a recession, you stay open for a little bit, and then the recession recovers and you start generating revenues again, right? So you just lose 2-3 months of burn. The problem with our situation is some of these industries might be losing 12 months of burn, right? Because let's say travel, right? Airplane and all that. So 12 months of burn, it might be cheaper to hibernate, right? Bear the cost of the hibernation. There's a cost to downsize, and then build up. There's a cost to build up, but build up when you see the industry recover, right? So it's about runway, right? You have X dollars. How do you use the X dollars, right? Nothing more than saying think very clearly, right? If you want to stay open, what's the reason for staying open, right? Can you get revenues? Can you, if you cannot, then why are you open, right? Open for business when there's no business doesn't make sense, right? So these are all very tough questions. We've had companies that half the revenues went away because the bank stopped operating in the Philippines, for example, right? So
yeah, I see. Okay. So
yeah.
you were actually the first that I met that actually suggested hibernation as an option. So this is interesting. Okay, so I've checked the Q&A box and we have questions coming in already. So I think we should try moving on into this section, the Q&A section. And I want to start with these questions by Atta Gofrani. Hi, Atta. So the question is, a lot of these blitzscale companies of the past were B2C plays. Any shift being seen in the B2B space emerging in Southeast Asia? And if so, which areas?
Yeah.
Okay.
So B2B is really hard to do blitzscaling for sure, right? I think you know this. B2C is where all the blitzscaling has happened. B2C is where all the blitzscaling has happened. B2B is enterprise. So you actually have to sell to enterprises, and that's means some kind of sales force, etc. So Southeast Asia is a little bit mixed. My experience in China, I spent about 5 years in Beijing as a VC there. And my experience in China is that at a low GDP per capita point in time, around 10 years ago, about about 10 years ago to about 5 years ago, the GDP was around $4,000 to $6,000 per capita in China. Mm-hmm. SaaS business models, enterprise business models was really, really hard to do, right? Simply because people are used to just throwing more headcount at the problem, right? Just throwing people, because people were so cheap relative to software, right? So today, enterprise in China is starting to take off, right? There are funds set up to do enterprise in China. So enterprise, for whatever it's worth, tends to lag in tech, tends to lag B2C, right? And by about 5 to 10 years is my guesstimate. Southeast Asia is slightly different because you got a lot of MNCs headquartered here, right? Thailand, Singapore, Jakarta. So those will consume some level of enterprise. So you can actually, there's a small group of enterprise guys that are actually building global companies from Southeast Asia, but they're not going seriously after the Southeast Asian market. They're going after more sort of global type businesses from Southeast Asia. So, so I don't see a big burgeoning of enterprise deals opportunities from Singapore, because or from Jakarta or from Bangkok, simply because the market is very small in Southeast Asia for enterprise. And if you do that, typically you have some branch in the US doing sales also, because that's the biggest market for enterprise.
Okay, I see. Thank you. Now for the next question, we have questions about valuations from Yi Huin Chan and Dave Chu. So do you feel that valuations or funding will reduce across the board as investors may be more cautious with funding amount? And then also, should founders expect huge discount in valuation? As many argue that we are still pretty decent as compared to US and China before the pandemic.
Yeah, I think every valuations are coming down across the board around the world, right? Not just here, but so our valuations haven't come down as much because we weren't that high to begin with. I think the valuations in the US and China have come down very significantly. And it started actually before COVID, right? It started with post WeWork kind of environment. And COVID actually made it even stronger. So the thing is that I won't necessarily look at it as a discount. It's just where the markets are, right? The market size and the probability of success, failure, etc. I would look at I'll look at it as follows, right? As a VC, I don't want to give you insufficient money to grow your business. That doesn't make sense, right? Otherwise, why bother investing if you're not going to grow to a big company? But on the other hand, I don't want to take so much of your company that I become like the boss, the biggest shareholder, and then you're like an employee. That doesn't make sense to us either. You should be the boss. You should own the company. You should drive it, right, as an entrepreneur. So we're very careful with this. The valuation issue drives both those two things that we talk about, right? So if we cannot find a good spot where this works, we will talk to the previous shareholders to see if they can allocate more for the founders. And if not, we just don't invest. If the founders are like employees, then we're not interested in investing, right? The founders have to be leading the company.
Okay, I see. Okay, so we have another question, and this time it's quite specific to the travel industry, which is greatly affected by what's going on here. It's from Jordan Koo, and the question is, will we be seeing significant down rounds for the travel unicorns like Traveloka or Klook, or will it make more sense to raise convertible notes instead?
Yeah. So first point is, the most important thing for you to do if you have a company, especially in a travel company, is to make sure you have enough runway to survive this downturn, right? And this is a long downturn. It's not going to be a short one. It almost doesn't matter. I'm trying to say it properly. It almost doesn't matter where you get a convertible note or you get a price round, etc. The most important thing is you have the runway in your pocket, in your bank account, right? I initially, when COVID hit, I saw a lot of companies switching to convertible notes, right? And because they are trying to preserve their valuation and all that. And in the end, a whole bunch of them realized that's tough, let's just do a round, and they took the down rounds, right? I think in the short term, people will try to optimize for valuation and amounts raised, etc. But in the long run, if you take a big picture view of life, it's much more important to be alive and healthy, right? Even if you take the dilution now, and you cannot expect to, I think you cannot expect. So Traveloka just raised, I don't know what valuation they raised at, but I think it's hard to expect the same level of valuation as before, right? Airbnb also just raised $1 billion. Maybe they have different types of instrumentation around it, preference stack, etc. But I cannot imagine raising at the same level as the previous round, right? It's just the economic situation is just so different at this point.
Okay, I see. So now we have another question that is still related to the different sectors and verticals. So this one is from Abhishek. Hi, Abhishek. How do you see sustainability sector doing? Is carbon offsetting market an interesting sector now as healthcare and environment are taking center stage? So would you consider going into this fund as well?
So specifically the carbon trading platforms, we've seen zero of it the last, let's say, a year, 2 years. I think that was a fad that came up and then sort of fizzled away. It's almost like cryptocurrencies, right? Boom, and then you don't see much of it after that. So frankly, at this point, I don't know how those companies are doing, the carbon trading companies. I kind of find it harder to think of sustainability as a vertical. I think you use the term sustainability to describe a bunch of companies doing certain things as opposed to a particular vertical. I think carbon trading might be the only one that sort of falls in that kind of horizontal view of life, for sustainability. Yeah. So I'm not sure if I answered that question, but maybe you can elaborate. I don't see the question here, so I'm not sure if I got the whole context.
Yeah, I think the question was more about whether sectors that are strongly related to environmental sustainability will continue to remain popular here, since everyone seems to be focusing more on, oh, healthcare, e-commerce, fintech, what
Yeah,
sectors that can, like a direct impact at the moment,
yeah,
but how those that are in the long run.
yeah. So the challenge with so environmental sustainability projects is a lot of it's got um, sort of non commercial drivers, so they don't go to the same investors as the tech services companies, right? So they go to the what do you call it, impact funds and all those, sustainable funds. So I don't see those deals as much. So it's hard for me to tell you how the environmental deals are doing, simply because they don't come to us that much, right? Um, they tend to focus on the impact funds as investors.
Okay, I see.
So not the best person to check with on this.
All right, no problem. Right, so we also have a questions about, this is more on the geographical approach. So it's from Aiklim Low. And where do you think is the up and coming startup hotspots in Southeast Asia, where you are finding good deals even in the current climate?
Today is still Singapore and Jakarta, right? Those are the two. We expect Jakarta will overtake Singapore in terms of just the number of deal counts at some point. Right? We can see the trend lines going. That said, I think Bangkok was coming up very nicely. We not very clear on how COVID is affecting that. People might get more conservative and go back to work for businesses, etc. So we haven't seen the effects of that. So those would be the three. Oh, Saigon, of course, Ho Chi Minh City. That's actually because the economy in Vietnam was actually doing very well before the COVID situation. But there's a lot of externalities in the Vietnamese economy, so that might slow it down. But so I would say almost in that kind of general order: Jakarta, Singapore, Bangkok, Vietnam, and then KL and Philippines, Manila sometimes have interesting deals, but it's not as vigorous. There are people in the ecosystems trying to drive some of that activity there, but the bulk seems to be Jakarta, Singapore, and then Vietnam, Bangkok.
Yeah, we also noticed there are lots of activities in Vietnam in our news coverage lately.
Yeah.
Right, so the next questions are about Pivot. We have one from Edward Semo and then another one from Facebook from Sino. So assuming that pivoting during this crisis is the right strategy, is it pivot? Yeah, so is this the right strategy given that these ventures will have to go back to their previous model once the crisis is over? And if it's yes, then how to do it properly?
Okay. So in that question, I'm assuming there's some level of pivot that the company is executing. Sometimes the pivots are not real pivots, but just adjustments to scale. So let me give you one positive example, and then one, where we have to go figure out what to do. There's a company we invested in called Padlet. They are basically providing collaboration tools for students and teachers in schools. So you can imagine the last 3-4 months of just going crazy, right? And they actually have a lot of challenges because they're not, their MAUs is in the millions and they're doubling, right? Almost every month. So the infrastructure wasn't ready to handle that. So they were really, really busy sort of redesigning the whole server stack and to try and to try and make sure they don't crash. The biggest challenge the last 3 months was let's not crash, right? So that's really not a pivot, but it was a set of work that was going to be done over the next year, 2 years. They had to do it in 3 months, right? So that business has to think through, okay, once they acquire all these users, how do we keep them post-COVID, etc. That's one thing, right? So that's one example. We have another example where COVID took out the majority of its B2C business because the banks shut down, and in Indonesia basically stopped aggressively pursuing customers. And so it was left with this core business that is B2B. And that business is still throwing off millions of dollars in revenues. In fact, it's going up because the banks realize they need to automate, right? So we ended up being much more focused on revenue generation from that entity, the B2B business, and then focus a lot less on the B2C. But as the countries are opening up, the banks start being aggressive on getting customers, etc. And frankly, the governments would start injecting stimulus through the banks in form of loans to SMEs, right? When that all starts happening, we expect this business to come back up, right? And one of the things the CEO did was he put a lot of people on variable pay, so you can furlough. When you don't have the volume, you don't pay for the people. When it comes back up, you can ramp it back up. So you got to think through, your contracts with your employees. Are they employees or contractors, things like that. So you got to think through how you survive the going down and the coming back up. That makes sense.
All right. Okay, I see. Yeah. So the next question has a strong correlation with the e-commerce and fintech industry, and I want to start with the one from Gerald, who is asking the question from Facebook. How do you foresee the e-payment scene developing in Singapore and Southeast Asia? Will it stay fragmented, like the way it is today, or will it become more like China when there are only few big players? So how do you see the sectors up? I mean, since
invariably these businesses consolidate because there's economies of scale. So I don't expect there to be 50 e-commerce companies or even 20 e-commerce companies in the next 10 years. Right? If you look at what's happened to Amazon, one of my friends who pays attention to retail in the US is telling me, there's always this debate about retail stores and then Amazon, right?
Okay.
He basically said COVID answered the question, Amazon wins, everybody else loses, right? And the economies of scale even will make it hard for the governments to sort of control these big monopolies, right? Because they can provide you much cheaper logistic, much cheaper products because they have the scale, right? The question is, if you start controlling that, what they can do, then the costs will go up. So the consumers will have to bear the cost, right? So I don't expect in our part of the world, it'll be like China, right? There's 2 or 3 companies that can control most of the e-commerce in China, right? And I think it'll end up something like that here. You're going to have a lot of very specialized sites for sure, right? But if you do dollar amounts, number one will be like 60, 70% of the market. So yeah, financial services are different than retail because there's less of a economies of scale impact.
Okay, I see. So yeah, and then to bridge from that question, there's also another one from Sunny Muhammad here. So do you think that the new retail model that is currently popular in China is coming to Southeast Asia anytime soon, especially since what we have happening now?
New retail, I guess what you're referring to is social selling, right? Social e-commerce. I think social e-commerce will be a saving grace for the small boutique SMEs that are selling online. Instead of selling through platforms like Amazon, which there are here, like, there are several platforms where small sellers in Tokopedia, in Indonesia being one of the very big ones, right? You can see that can happen, but you also see that what's happening in selling is that the entrepreneur is not just the supplier. They become like the curator for the consumers, right? So if they sell it to you, you know it's some level of good, some level of cool, whatever it is this guy is. So people don't go to them just because they can get the cheapest things. They go to them because they know that thing that's being sold is something that's suitable for the individual. So you get all these micro brands out there, Instagram stars that people follow, and they'll buy from them, right? So I think that would be sort of a new channel of selling. In the US, you've got this, what's that lady? She's like the youngest billionaire, and she's basically doing this social selling, right? So you can see even in the US, this is working. So that will change e-commerce a bit, right? But for day to day, when you buy anything from rice to clothes and all the regular stuff that's not branded, you probably end up looking for the cheapest or best price, and that will be the big guys.
And how about the O2O model? Do you still see that since everybody tends to shop more online, are you still going to have that element? Mm-hmm.
O2O in China ends up very specific, like furniture, big pieces, big things. But that's for e-commerce. But I think almost all of what we talk about in terms of technification of services, all the different service sectors, real estate, headhunting, and of course retail is one of them, logistics, etc. Those guys have a very if you start looking at how to solve the problem from a full stack point of view, then there's a component that's offline, right? Like headhunters, maybe you need to meet the candidate or meet the hiring manager, right? So you need a human being to go do that. So that's O2O in some sense, right? I don't know if you're referring to O2O from the e-commerce sense where you have a shop and people go like Apple shops or Apple stores, or in general, I think of O2O as any business that's online and offline at the same time, and you need the collaboration of these two to make it work. I'll give you an example in real estate where we've seen the evolution of it used to be, you advertise your houses for sale, and then you go online and it's like classifieds. You look for, here are 50 houses that you could buy at this price in this area. Well, it might be okay for the US where the agents are there, the MLS is there for you to understand the pricing, you can do comparisons, you can, all the information is there, banks are there to lend you money, etc. But out in Southeast Asia, a lot of these pieces and the information is missing, right? So the right solution is to have almost an agency approach, someone to help you find the house, get the loans, evaluate the comparables, buy a house, offer, that whole process until you move into the house, and maybe even renovations, right? So that whole process becomes a solution. And that to me is O2O, right? It's online, it's offline. Right? So how do you solve that problem? And if you can solve that problem in a very high trust environment, then you are okay.
All right, okay. Now for the next question, this has more to do with the fundraising process itself. So this is a question from Atia Kazi. As a VC, what are the most important assumptions you look at when reviewing pro forma statements? How can startup come up with realistic assumptions for projections given the current situation?
Yeah, pro forma statements are personally, I look at those in terms of trying to understand how the entrepreneur thinks. I can guarantee you one thing. You show me a pro forma statement today for the next 12 months, I can almost guarantee you, it will not be what it says 12 months from now, right? This is just what you hope the world is going to be, how you drive, how you plan to drive the world in that direction of the pro forma. So when I read the pro forma, I'm asking myself, what is this entrepreneur assuming, what they're pushing for, how they think their business can grow, and are they logical in thinking through the assumptions of the growth drivers, right? And this is where a lot of companies fail. They do a lot of sort of OpEx planning, how much money to spend, but they don't think enough about how much money I can make and why, right? So they don't have a deeper understanding of where that money is going to come from, the top line driver as opposed to the bottom line burn. Burn is almost totally under your control. I mean, is the top line that's got a lot of missing information, and the depth of thinking along the top line is where, you know, the good entrepreneurs differ from the general entrepreneurs.
All right. Okay, I see. All right. So right now it's 3:20 p.m. I think we have room for one more questions, maybe just a short one. Let me see. Yeah. So the big news today is about the iFlix being acquired by Tencent. So Jordan here is asking, can you advise in terms of learnings? What kind of pitfall that we should avoid from a deal like this?
Sorry, can you repeat the question?
Can you advise in terms of learnings, pitfalls to avoid from the deal? Because what happened is that, yeah, their business is struggling, and then it is stated that they're being acquired for much less than their original valuation. So,
you know, so I don't have the details of that particular situation, so I don't know what the issue is. The analogy I draw when you do business, the analogy I draw is like if you go fight a war, right? You step on a battlefield. If you're standing in the wrong place, wrong by, you know, results, I guess, a bullet hits you or a shell explodes next to you, you're dead, right? So who would have thought that, for example, the travel business is going to be really hard hit this year, right? That's like going down to zero. You know, you just happen to be in the wrong place at the wrong time, right? If you had a travel business 15 years ago, you could be Priceline, right? But it just so happens this year, it's just the wrong time. So when we are critical of entrepreneurs, we got to be clear on what's the result of bad strategy and bad execution and bad planning versus, you know, I hate to say this, but bad luck, right? Because luck actually does have a part to play in this, right? You look at these black swan things, and it's not the entrepreneur's fault. You know, how can they possibly expect that, right? So I think be a bit more, when you see failures, and most startups fail, right? Be a bit more critical in terms of how you think about how they fail, right? It could be really they're responsible for it. They just didn't manage the business properly, or it could be the business just fell out from under them. You know, the economy just changes. I don't know if that answers the question.
all right, okay, I see. All right, so I think that's basically the end of our Q&A sessions. Thank you, everyone. It's one of the most exciting questions that we received today. Now, so before we end the webinar, I'd like to share some messages. So this is about our E27 Pro. So what Monk Hills Venture is one of the investors that is part of the E27 Connect program, where we have over 250 investors like them who are looking to connect with early stage startups for investment that is ranging from pre-seed to Series B rounds. So please check out our membership program and feel free to connect with our team to understand more about it. And yeah, next week we will be back with another session with PatSnap CEO and co-founder Jeffrey Tiong, and they're going to explain more about how they went from being a sales-led to product-led company, and how to pivot your growth strategy post-pandemic. And also don't forget, if you enjoy our webinar, kindly take the time to let us know the other topics that you wish to hear about and how we can improve the event by filling our feedback survey, which will be shared later on. And then also, if you have any questions or comments or anything, feel free to connect with us, the E27 team, using Facebook. And then we also have a Telegram channel for more community discussion that you can take part of. So now we're basically getting to the end of the events, and we would like to say a deep thank you to Peng and his team at Monk Hill Venture for helping out in this event. So do you have any closing statement that you would like to give to the audience?
No, I think this is a really tough time for entrepreneurs, for business people to be operating in. I think you need to take care of yourself, make sure you're mentally thinking straight and thinking sharp, and do your best to get you and your team through this situation. Right? If you need, and I think very importantly, make sure you have a network of people that you can talk to that's not in your company, because you need perspective from people around you. So build up that expert group, if you will, advisors, if you will, and listen to what's going on around the world. All the best. That's all I wish for you. All the best.
Yeah, it's very important to have basically a support system, especially in times like this. And yeah, at E27, we also see that a lot of startups are doing their best to help each other, like by hosting community events and then just supporting each other through mentorship. All right, so thank you everyone for tuning in. It's very good to see you all here today. And thank you to Peng and Monk Hill Venture teams for your time. And please stay safe and take care, everyone.